Thank you for joining me today. My name is Justin Carbonneau. I'm Vice President at Validea. Today's presentation, Top Quant Stock and ETF Strategies in a Historic Market. We'll look at the active stock and ETF models on Validea to see what is working and why. In an effort to maximize our time today, I want to jump right into the presentation. So here's the presentation's big idea in 164 words. I'm going to read this to you so it's very clear as to what we're trying to get out of today's discussion. So far this year, the US stock market has seen one of the worst and best quarters in history. This has created fear, confusion, and insecurity in many investors' minds. But it has also created interesting opportunities for the disciplined investor as he or she looks to navigate this market. In this presentation, we'll look at some of the very best performing styles and strategies on Validea.com, our flagship research site. We'll look at the top active stock selection models in ETF portfolios so far this year and also off the bottom in March, and we'll see how they're very different styles. We'll discuss how these models are constructed, the investment criteria used, the types of stocks and ETFs they select, and the performance in this historic market period. As you look to expand your investing knowledge and improve your chances for success over the long term in the markets, my hope is one or many of these models we look at today can help you in your investment research process. So here is a quick outline of today's presentation. First, I'll give you a brief introduction to Validea and our investing models. We'll then look at the top performing stock selection strategies year to date and since the low in March. We'll look at the top ETF strategies year to date and since the low in March. We'll walk through each of these methodologies in detail. I'll explain the key investing insight, the strategy, the evidence, and the investment thesis behind each one in today's environment. And then we'll look at the actual investment criteria used in each one. I'll also show you how we've implemented these strategies on Validea.com. And then if we have time at the end, we'll get into some Q&A. I know on today's webinar, we have some investors who are very familiar with Validea and what we do here. But for those that don't know much about us, let me just spend a moment giving you an overview of what Validea is and what we do here. Validea is an independent investment research firm with no conflicts of interest. We've been developing and running quantitative stock selection models based on great investors and other proven strategies since 2003. The models we build and that investors use in their investment research include stock screens, investment factor rankings, a stock analysis engine, model portfolios, trend following system, ETF model portfolios, and much more. My partners, John Reese and Jack Forehand, wrote the book, The Guru Investor, and we produce the Validea Guru Investor blog, where we post original investment commentary and curate interesting articles on investing in the markets from around the web. I am one of the hosts of a relatively new investing podcast called Excess Returns. There's various levels of usage of Validea. We have Validea Standard, Validea Professional, and there is some parts of the site that are free in front of the paywall. And lastly, we manage money for private clients using many of these models through Validea Capital Management, which is a separate investment advisory business where we run portfolios for high net worth investors. Let me read you this quick disclaimer. And then I'll read you a performance disclaimer just before we begin. None of the individuals mentioned in today's presentation endorse any of the strategies or implementation of these strategies. Validea's models are extracted from publicly available sources, books or academic papers, and are not meant to represent the gurus or individuals themselves in any way. All of our strategies are quantitative in nature, and the gurus themselves may have changed, altered, or never followed these exact strategies. The information presented today is intended to give you an understanding of active and quantitative stock selection strategies only. In addition, individual stock selection can be very risky, and none of the material discussed in this presentation should be construed as investment advice or as an individual stock recommendation. There is a more comprehensive performance disclaimer here. I'm just going to leave this on the screen for a moment, but the summary here is that the returns you are going to see in today's presentation are model returns. They are not live actual money management returns. And as with any investment strategy, there's a potential for profit as well as a possibility of loss. And investors may incur a loss despite a past history of gains. Past performance does not guarantee future results. Results will vary with economic and market conditions. Please read this disclaimer in full before moving on. So the first question we want to ask is, how do we here at Validea go about identifying successful investors and strategies? We look at three key criteria when finding a strategy and implementing it on Validea. The first is a strategy needs to have a long-term track record of market outperformance, either real-world performance backing it up or back-tested. The second piece is the strategy needs to be publicly disclosed, either in a book, an academic paper, or another source. And lastly, the methodology needs to be largely fundamentally based and one that can be captured and run quantitatively via computer programming and modeling. Since 2003, we've been building computerized investment strategies by or about the following individuals and investors. We capture these strategies and model portfolios in a quantitative stock analysis system. I'm going to quickly walk you through who these individuals are and the source for the model implemented by Validea. I'm going to go from left to right and top to bottom, and I'm going to do this relatively quickly. We run a model based on Peter Lynch's growth at a reasonable price investing approach that he outlined in his book, What Up on Wall Street. There's a contrarian investment strategy based on David Dremen's book, Contrarian Investment Strategies. We run a strategy based on John Neff's value screen, which is outlined in John Neff and Investing, and that will be one we'll look at later in the presentation today. We have another value investing model based on the writings of Ben Graham. This is a value approach that he discussed and wrote about in his book, The Intelligent Investor. As many know, Graham is the father of value investing and had a huge influence on Warren Buffett's investing style early in his career. There's a model based on Ken Fisher's approach in the book Super Stocks, where he popularized the price to sales ratio. The Magic Formula by Joel Greenblatt, which we extracted from his book, The Little Book That Beats the Market. This is a combination of Graham's value approach and Buffett's focus on quality, bringing these two concepts together into one simple systematic model. The Cancel Method, which was developed by William O'Neill and written about in his book, How to Make Money in Stocks. A model that seeks to replicate Warren Buffett's strategy as best we can by looking for high-quality blue-chip type stocks that are attractively priced. We built this methodology using the approach outlined in the book Buffettology. There's a growth investing model explained by Martin Schlag in Winning on Wall Street, a model based on the research done by Meb Faber in his book Shareholder Yield. Shareholder Yield captures the ways a company can return cash to shareholders. We run multiple strategies based on the work and backtesting of James O'Shaughnessy in What Works on Wall Street, which is a seminal book on systematic and simple quantitative strategies and the ones that work best over the long term. On Validea, there's a small cap growth investing model based on the Motley Fool Investment Guide, written about by Tom and David Gardner, the founders of the Motley Fool. Another deep value model extracted from Tobias Carlyle's book, The Acquirer's Multiple. Wayne Thorpe, an analyst at AAII, wrote about and tested an earnings revision model, and his report had a profit from revisions in analyst earnings estimates. A growth investing strategy taken from Partha Mohanram's research. The name of that paper is Separating Winners from Losers Among Low Book-to-Market Stocks Using Financial Statement Analysis. This is a model we'll look at today. Another value model based on the research and testing of Joseph Piotrowski from his academic piece, Value Investing, a historical look at financial statement analysis information to separate winners from losers. A strategy using Patrick O'Shaughnessy's research and long-term testing from his book Millennial Money. A dual momentum approach modeled after Dishang Hang's academic study, Twin Momentum, Fundamental Trends Matter. That's another strategy we'll walk through. A pure momentum model extracted from Wes Gray's book Quantitative Momentum, a multi-factor and low volatility strategy based on the work and writings of Pim Van Vliet. And also another model that we'll look at is the private equity investor model, which is extracted from an academic paper that we'll talk about in a few minutes. There's really two other points I want to mention here. One is that every one of the strategies I just mentioned can be read about in books and or academic papers. These sources exist for you to reference and learn from. You can buy the books on Amazon, and almost all the research papers I mentioned are free on SSRN with registration. The second point is we do our best to implement the models as they were outlined in these sources. So we're not trying to reinvent the wheel here. What we're trying to do, and what hopefully I'm going to show you today, is that parts or all of these stock selection approaches can be used to help analyze stocks and or find new investment ideas with a little bit of effort. Okay, switching gears just for a moment, let's talk about some of the trends that we're seeing so far this year in what is a historic market environment. As I mentioned, stocks saw one of the worst quarters in history in Q1. Now they've seen one of the best quarters in history in Q2. But what are some of the trends underlying those significant market movements? Well, the first thing is that so far this year, growth and momentum strategies and stocks have beaten value stocks and strategies. So investors are paying up for high growth and the companies and stocks that are performing well, and the stocks that aren't doing well, which have tended to be more value type stocks or cheap stocks, have been some of the worst performers. Since the March low, however, small cap and value strategies have seen a huge reversion and have been some of the best performers. So you sort of have the tale of two tapes where you have growth and momentum for the full year, but since the March low, value has come back significantly. The other thing that we'll see in a few minutes is that strategies that look to manage risk and that have considered alternatives to a 60-40 portfolio actually have been somewhat effective in managing that risk in what has been a pretty volatile market. From a sector standpoint, healthcare and technology are some of the leading industries for the year, but since the March low, some of the sectors that have been beaten down the most, like consumer cyclicals and capital goods, have come back the most. And then the last thing, and we'll see this on the next slide, is that the major market indices like the S&P 500 and the NASDAQ actually mask how some of the certain segments in the market have declined. And we'll take a look at that on this slide. So I pulled this data together just to show some of the losses and subsequent gains we've seen and to try to put some of this in perspective. So what I did is I took the stocks in our investable universe, which is about 3,000 names, and I looked at the average stock decline and recovery since the March low in each of these sectors. So as you can see from the table, the declines were pretty massive all the way until March 23rd. Actually, most of the declines happened between mid-February and March 23rd. You had conglomerates down 56%, consumer cyclicals down 46%, energy was down more than 67%. And this is the average decline. So some stocks were actually down more than these numbers. There was clearly a lot more pain in the market, in certain areas of the market versus others. For example, I mean, the tech sector, which we know is where a lot of the growth-like companies are, was only down 29%. But we've seen, you know, a massive move back higher as the market recovered from those lows and as investors realized that maybe, you know, things, at least in the short to midterm, weren't going to be as bad as many had predicted. But obviously, that was a very painful period, and there's still a lot of uncertainty in the market. And, you know, those types of declines are hard to deal with. Just in terms of the, you know, you hear this phrase a lot, and it's just the math, that if something falls by 50%, you need 100% gain to get back to your starting point, your original value. So what I thought I'd do here is just to drive home what type of gains you need after such a large decline. I use the energy sector's actual average stock loss as an example. So let's say you started at the beginning of the year with $100 invested in the energy sector, and on March 23rd, that $100 was worth $33 because of the 67% average stock decline in the energy sector. In order to get back to 100, so to get back to your starting point, you actually need to see a 200% gain to get back to break even. Of course, that's possible, and you know, some of these energy companies will be able to deliver that, but it just goes to show how big the how large the move back higher is you need to get back to that starting point. And this is important because some of the value models that we're going to look at, the performance since the end of March has been massive, and they've moved significantly. But for the most part, most are still well below the S&P for the year because the losses were so big coming in. Okay, now with those returns and some context on the types of declines and the recovery since the low, let's look at some of the better performing models on Validea over those various time periods. So on a year-to-date basis, the #1 performing strategy so far this year is the price to book to growth investor strategy based on the method outlined by Partha Mohanram, an academic from the University of Toronto. In his paper, Separating Winners from Losers Among Low Book-to-Market Stocks Using Financial Statement Analysis, he had identified and outlined a growth type of investing strategy. We'll talk about that in a few minutes. This model portfolio, the 10-stock model portfolio that we run, is up 23% so far this year. The second best performing model is a model that is called Twin Momentum. This was extracted from another research piece written by an academic, Deshaun Hang, and his colleagues. This model is up 10% so far this year. This is versus the S&P 500, which has returned negative 1.6%. So the S&P has come way back, but these growth and momentum models have done even better. What's interesting is from the March low, however, the performance completely flips, and it's some of the deeper value models that have bounced back tremendously. So the best performer is a 10-stock monthly rebalance portfolio based on the research and strategy extracted from the paper Leverage Small Value Equities. The portfolio is up over 88% since the March low. And then the second best performing strategy is the model that incorporates John Neff's value investing approach which we base and extracted from the book John Neff on Investing, and that's up over 86%. So when you see numbers like that, as I mentioned before, obviously those are huge reversions off of the low in March, but those strategies were down massively as well. So in some cases, they haven't even got back anywhere near break even. But those investors that were allocating to value, in March and early April, they've obviously done really well. The other thing worth mentioning is these are highly, highly focused 10 stock portfolios. So the level of concentration is just massive, and these are very risky strategies, and they have large amounts of deviation from the broader market. So I don't want to make it like these things go straight up all the time. I mean, they have massive downside volatility too when it comes. For the next part of the presentation, we'll walk through each of these 4 models in detail. I'll share with you the specific investment criteria each one utilizes, and we'll discuss the key fundamental investing insight along with the source and the long-term evidence behind each of the strategies. I'll then provide you with what I think is a reasonable investment thesis for this type of strategy in 2020 and beyond. The first model we're going to look at is the price to book to growth investor model. This is a strategy that seeks to identify winners in the growth stock category. The key investing insight here is this. Within the growth stock universe, which tends to be more expensive stocks, looking at consistency in fundamentals versus the competition and reinvestment in the business are positives. At a high level, the strategy looks for growth stocks by seeking out those stocks that have low book-to-market ratios and that exhibit characteristics via their fundamentals and the trend in those fundamentals that are associated with strong future sustained growth. The source and the evidence behind the strategy, this is based on the paper separating winners from losers among low book-to-market stocks, written and published by Partha Mohanram. In his study, he found that by going long the best scoring stocks and shorting the worst scoring stocks, a long-short strategy in his backtest generated a 20.3% annual return from 1979 to 2001 versus 11.3% for the S&P 500. The investment thesis here is this. Expensive stocks generally underperform the market, but by applying a series of fundamental strength and reinvestment criteria tests, you can identify outperforming stocks among those expensive stocks. Top growth names have been winners in this market. Should that trend continue, this model looks poised to continue to benefit. Now let's look at the actual investment criteria used in this strategy. So the first thing we need to ask is, how do we identify those stocks that are growth-like stocks? So in order to do this, what Mohanram did is he looked at the book-to-market ratio, which is the inverse of the price-to-book, and he wanted the stocks in the lowest 20% of stocks based on book-to-market, which would essentially be the highest 20% based on the price to book. It's just those two ratios are inverse of each other. So to start, it says, I want the 20 most expensive stocks in the market, and within that group, you're going to find a lot of growth-like companies as investors pay up more for those growth-like stocks. The next step is to reward companies that are both profitable and have above average cash flows. So here, what the model does is it wants to see return on assets above the industry average. It wants cash flow from operations to assets to be above the industry average. And then it looks at cash flow from operations to assets versus return on assets also being above the industry average. So if those 3 criteria are met, those are all positives. Next, it looks at the underlying variability in the business and the fundamentals. So here it rewards businesses that have more consistency in their numbers versus the competition. So the first thing is it looks at the firm's variance of return on assets. It wants to see that to be below the industry average. And then next, it looks at the variance in year-over-year sales growth, and it wants that to be below the industry average. Next, it says, is the company investing in the future? Is it putting its money to work in productive ways that could help fuel future growth? So what the model does is it looks at R&D, CapEx, and advertising intensity. So these are 3 ways that you can measure whether a company is investing in future growth. And it wants to see that the spending on those, or the ratios there, are higher than the industry average. Lastly, there's a final score. So each of those criteria are given a score of 0 or 1, whether it passes. And stocks that score or meet all of the criteria are the ones that are held in the portfolio. So those are the top rated, what Mohanram calls G-scoring stocks. So this methodology he actually called the G-score. If people are familiar with the Piotrowski model, Piotrowski has a value strategy called the F score. Well, Mohan Rand came up with the G score. And that's the model I just outlined there for you. Okay, shifting gears to the second best performer year to date. This is another strategy that uses or looks for companies that are probably growing. But what this strategy does is it combines price and fundamental momentum. So the key investing insight here is this. Buying stocks with strong price momentum is effective, and so is buying stocks with improving fundamental momentum. But combining both fundamental and price momentum, or twin momentum, works even better. At a high level, this is a stock selection model that combines these two concepts, strong price momentum and strong fundamental momentum, and the fundamental momentum is measured using a series of accounting and quality-like metrics. As for the source and the evidence behind this strategy, this is based on a paper, Twin Momentum, Fundamental Trends Matter. This is written by Deshaun Hang and his colleagues, and in their test from 1975 to 2015, they found that by combining price momentum and fundamental momentum, that factor more than doubled the performance of the standalone factors of price momentum only or fundamental momentum only. The investment thesis here is this. The combination of the improvement in fundamentals along with relative price strength presents investors with a way to harness the momentum premium and have it be more than just based on positive stock price performance, since fundamentals are also being considered. Okay, let's look at the details behind the twin momentum investor strategy. So to start, this looks at 7 key fundamental factors. So it looks at earnings, return on equity, return on assets, accrual operating profitability to equity, cash operating profitability to assets, gross profit to assets, and the net payout ratio. So these are all different ways to measure and get at the quality of the firm, and is the firm operating, is the firm sort of fundamentally financially sound. And what it does is it looks at the trend in these things. So it says, is the trend over the last few years positive? And stocks are scored based on each one of those measures, and there's a final fundamental momentum score that's rendered for each security. Next, it looks at price momentum. So here we want to see stocks with the strongest price momentum. So stocks are ranked based on their intermediate term momentum, and the 20% of stocks that score highest based on this intermediate term momentum score are then eligible for the final step, which is the combination of the first 2 criteria. So what's happening here is stocks are receiving a fundamental momentum rank, they're receiving a price momentum rank, and then there's a final combined twin momentum rank, and the stocks in the top 1 to 2% of all stocks are the ones that are included and eligible for the portfolio. Okay, now we're going to shift over to the value models. Remember, these are the models that have seen the largest reversion higher since the March low. The first is the private equity investor model, which takes the concepts behind what we know give private equity and leveraged buyout firms potentially really strong returns, which is buying stocks or firms with leverage and trying to wring out operational efficiencies and then sell those companies down the road to try to get excess returns on the investments that they're making. What this model tries to do is take some of those concepts and apply it to the public markets, so to apply it to publicly traded stocks. The key investing insight here is this. Investors can attempt to mirror the returns of private equity without the high fees using a portfolio of publicly traded leveraged small cap value stocks. The strategy looks for stocks that are inexpensive based on the enterprise value to EBITDA multiple, and then attempts to leverage that value exposure by focusing on firms with above average debt that have demonstrated the ability and willingness to pay the debt down. As for the source and the evidence behind the strategy, this is based on a research paper published in 2015. The name of that paper is Leveraged Small Value Equities. And the researchers showed in their test that from 1965 to 2013, a back test holding the top 25 stocks according to this model returned 25.1% annually over that period of time, which is a phenomenal backtest return. The investment thesis here is this. The returns of the value factor can be magnified by investing in firms that responsibly employ operating leverage in their business. And also, if the value reversion continues, if value stocks continue to perform well, this strategy could certainly continue to be a beneficiary of that. Okay, let's look at the actual investment criteria used in the model. So to start, what this model does is it isolates small cap companies. So it basically says the only companies eligible to be bought or included in the model are those that have market caps between the 25th and 75th percentile. This essentially removes micro cap companies and it removes really mid and large cap companies. So you have a whole swath of small cap companies within this percentile range, and that's where this strategy focuses. Next, it says, okay, of that universe, we want to buy the cheapest stock. So here it uses enterprise value to EBITDA, and it will only then score or filter stocks that go to the next set of criteria that are in the bottom 25% of the universe. So it wants the cheapest stocks in the small cap universe using that specific valuation metric. Next, it says, okay, we want to find companies with above average debt in relation to their enterprise value, because that debt, as it gets paid down, is one of the big reasons why these companies go on to outperform well, at least the ones that survive, because as the debt comes down, bankruptcy risk comes off, and you get multiple expansion and some significant returns when a strategy like this is working. The 4 criteria that are used in the strategy to help measure a company's ability to repay its debt are the change in long-term debt, so is debt falling over time, long-term debt to assets, basically companies are percentile ranked based on this, gross profit to assets is another percentile rank, and then asset turnover, is that improving, is that increasing? That is an indication that the assets of the firm are actually being used efficiently in order to drive sales and revenue. The next strategy we're going to look at is a model based on the John Neff approach. This is the number 2 best performing strategy since the March low. And the fundamental investing insight here is this: sometimes investors overlook the importance of strong dividends and the concept of total return and beating the market over time, and that's what this strategy tries to do. The strategy starts by looking at stocks with PE ratios that are between 60 and 40% of the market. So it wants a discount relative to the market. From there, it looks for firms with steady, sustainable EPS growth and positive free cash flows. The source and the evidence behind the strategy, this is based on John Neff's book, John Neff on Investing. From 1964 to 1995, Neff guided the Windsor Fund to an average annual return of 13.7%, easily outpacing the S&P's return of 10.6% over that same time frame. The investment thesis here, looking at the firm's total return to PE ratio, which considers both dividend yield and earnings growth rate, can be a superior method relative to standard valuation metrics as a way to identify undervalued firms. And in the same way that the private equity model will be a beneficiary of values reversion, a model like this that looks for cheap stocks and looks at these other factors, I think will also continue to be a beneficiary should value stocks continue to perform well now and in the future. Okay, let's look at this model in a little bit of detail. So the first is, how do we identify stocks that are value type stocks? So here the model looks at stocks that are trading at a 40 to 60% discount to the market. So if the market multiple was 18, we would want something like, I don't know, stocks that have a PE of between maybe 7 and 12, something like that. But the model also wants to sort of find companies that are exhibiting decent growth. So it likes to see earnings growth between 7 and 20%. It doesn't want stocks that are growing only at 1 to 2%. And it also doesn't really favor stocks that are growing at 25, 30, 40%. Those tend to be pretty expensive stocks. So it tries to find these like dull type of stocks in what I would call like, medium growing market. Next, it looks at future growth. So it wants to see that the earnings estimates are for the current year and over the long term be at least 6%. So here it's looking at the future earnings estimates from Wall Street and seeking out at least the 6% and 7%, 6% earnings growth and 7% sales growth. Lastly, it takes the total ratio, which is basically EPS plus dividend yield divided by PE ratio. It wants to see that being at least double the market. So that gives you a sense of what the total return could be by looking at both the dividend yield and the EPS growth rate relative to the company's valuation. Lastly, there are 2 bonus criteria in the model. So the model rewards companies with positive free cash flow and companies that are exhibiting earnings persistence. So it wants to see a steady increase in earnings over the past 4 quarters and over the same quarters in the previous year. And that shows that, earnings are sort of stair-stepping up and being persistent in nature. Okay, so now that we've looked at the models, let's talk about the way that these can be used by investors. And there's really two ways that an investor can use models like this. The first is an individual stock analysis. So you can utilize the fundamental criteria in these strategies and apply it to your own individual stock research. If you're researching a name or looking at a stock in your portfolio or a stock in your watch list, you can start by using these models, honing in on the key financials, valuation metrics, and even technical variables, things like momentum, that may have been deemed robust and important and outlined by these investors and by these sources. You can then start to incorporate rules and maybe thresholds in your own process as you familiarize yourself with the strategies and the investment criteria that goes into them. You can also use these strategies for investment idea generation. So you can create a screen. You can extract the fundamental criteria outlined and tested by these investors. A screen allows you to source ideas very efficiently. You can look through hundreds or even thousands of stocks quickly as a way to sort of find investments that meet the criteria outlined by these strategies. And in addition, you can create model portfolios, which is one of the things we do on Validea, and I'll show you in a second. You can create portfolios that hold the top scoring, top rated stocks according to each one of these strategies. So we're going to quickly look at 3 different features on Validea, and I'm going to show you how we've implemented these strategies in the tools and features that we run on the site. Now we're going to take a look at the Validea website, and I'm going to show you both a stock analysis tool using these guru strategies and 2 investment idea generation tools using the strategies. The first is something we call guru analysis. So to get to guru analysis, go to research and then click on guru analysis. What guru analysis allows you to do is see how any stock you're interested in scores through the set of the various strategies that we run on Validea. In Validea Standard, there's 12 different strategies. In Validea Professional, all 22 strategies are represented. So here, we're just going to look at Microsoft, ticker MSFT. And what we can see here is how Microsoft as a stock scores through the lens of the various strategies we run. So we talked about the twin momentum investor model based on Deshaun Hang. There's another model based on Pim Van Vliet. This is a multi-factor low volatility model. Interestingly enough, Microsoft scores higher than that. It also scores high on the Peter Lynch growth at a reasonable price type strategy. Strategy based on Jim O'Shaughnessy scores at 80%. The Partha Mohan price to book growth investor model scores at 70%. So when you see a stock that gets high scores based on multiple strategies like this, it's usually a good indication that at least fundamentally the stock scores highly according to some type of mix of growth and growth at a reasonable price or value type models. If we click into any of these models, so let's use, since we talked about Mohan, let's use that as an example. We can see why the stock gets the score it does. So I'm not in much detail, but as part of the Validea site, you can see inside the stock, almost like an X-ray, using these investment criteria as to why the stock passes and gets the score it does and the specific numbers behind it. It's an incredibly valuable tool that you can see how all these stocks score, any stock in your portfolio, if the stocks are fundamentally sound and what type of investment strategies either score them highly or don't score them highly. Sometimes if you see a stock that gets really low scores across the board, then maybe something fundamentally, either it's valuation or something on the balance sheet, or something on the income statement, just there's something not right. And so maybe that might help you actually avoid bad investments as well. Okay, moving on to the investment idea sort of way that investors can use these strategies. The first thing is the model portfolio. So what we do here is we run 10 and 20 stock model portfolios that consist of the top rated stocks according to each of the models on Validea. So there's a lot of portfolios here, and I was focusing on the 10 stock monthly rebalanced portfolios, and we were looking at the best performers both year to date and since the March low. So let's take a look at that. If we select monthly, so we offer monthly, quarterly, annually, and tax efficient rebalanced portfolios. If you're interested more in the portfolios, you can come to the site and watch our video tutorial or look at our user guide. But for the purposes of this presentation, let's go monthly, 10 stocks, and then let's do year to date. Now the performance numbers are going to be slightly different than what I had in the presentation, just because when I did the presentation and when I'm doing this live on the website, there's been a one-day lag, but don't get too hung up on that. So here you have the best performers this year based on our model lineup. So when we click into the portfolio, what we're going to see, and this is going to be the same across all the portfolios we run, but let me just show you real quickly. So what you get is the performance of the strategy over the long term. This, as I mentioned, is one of our better performing models on Validea. You have the full return history here for those investors that want to see how this model has done year by year. If you come down the page, what you're then seeing is the current portfolio holdings. So as I mentioned, this is a portfolio that holds the top 10 stocks and is actually rebalanced monthly, so it's an active portfolio. But here are the current stocks in the portfolio along with their performance, so you can get a feel for what is in there currently and how these things have performed. On this page, you can go back to any date in history and see the holdings at any point in time. There's also a fundamental view, so if you want to change this, we show basically the price performance view and then the fundamental view, which will show you the stocks and just some core fundamentals related to the stocks in the portfolio. Scrolling down the page, you see the latest changes. So we last rebalanced the portfolio on June 26th. The next rebalancing is on July 24th. 2 stocks came in, 2 stocks were removed. And then for some subscribers, when they start using the site, they want to see the current top-rated stocks in the portfolio. So if you were to start following this portfolio today, what would be the current top-rated stocks? That's why this table exists. So it's for people that come in between rebalancings and want to just get invested in the best scoring stocks based on what the model is currently suggesting. The last thing I'd like to show you, which continues on the idea generation part, is the Guru Stock Screener. And what the Guru Stock Screener allows you to do, it allows you to screen 4 stocks that meet one or many or a combination of strategies that we run. So I have just this defaulted here, so I'm sticking with the price to book to growth investor strategy based on the work and research done by Partha Mohan Ram. And what I did here is I filtered on strong interest, which means I want to see stocks that only score roughly. Strong interest is generally 90 and above, but in some cases it can be like 88 and above. So here are the stocks based on that one filter we're adding that score highest according to the Mohan Ram strategy at the current time. Some of the names you'll be familiar with, some of the names you might not be. We sorted this by market cap, which let's do that real quick. This is going to show us, it's going to sort the table ascending by market capitalization, and some of the names at the bottom you'll definitely be familiar with. Amazon, Google, Facebook, actually a lot of FANG stocks, J&J's in there, 3M's in there. So some of these might not seem like growth names, but again, it starts with, are the stocks expensive? Then it looks at these other factors to say, okay, is the likelihood that the company's going to be able to sustain that growth? So that's how you use the Guru Stock Screener. There's a lot of different ways you can combine strategies in that and other factors. So if you're interested in that, you can watch the video tutorial and or read the user guide. So far, we've talked about highly focused stock selection models, but what we also do here at Validea is run a series of quantitative ETF models and approaches. And for some investors, particularly those investors that are looking for more risk-managed type of strategies or alternatives, let's say to a 60-40 type of approach, or even strategies that focus on key investment factors via ETFs like value or top-rated sectors, the ETF strategies and portfolios we run can be very appropriate. So the ETF portfolios on Validea use value, momentum, and macroeconomic factors to rotate among factor sectors and even asset classes. We run factor and factor rotation ETF portfolios, sector and sector rotation ETF portfolios, and then a series of risk-managed portfolios. And that's, for the most part, where we're going to focus on when we get into the detail of these, because I think those are a nice complement to some of the riskier stock-only models that we just talked about. In terms of what's been working, at least so far this year, and also off the low. So on a year-to-date basis, as you may expect, the strategies that have managed risk have actually done quite a good job. And we'll look at these approaches in a little bit of detail in a minute. But just in summary, in the number one spot is a strategy that's called Generalized Protected Momentum. This is up 14.4% so far this year versus the standard 60-40 being slightly down for the year. This is based on approach outlined by Koenig and Keller, which we'll talk about. In the number two slot is the permanent portfolio, which is a pretty simple asset allocation strategy. That's up 10.5% this year. And then coming off of the lows, we have one factor and one sector model that have been the best performers. Unlike the strategies above, the risk managed ones, these ETF portfolios do maintain more constant equity exposure, at least these ones. So it's not a big surprise that the models, these two specific ones, have done the best as the model has, kind of come, as the market has come way off the lows in March. Okay, let's take a look at two of the reduced risk strategies, because I think, as I mentioned, I think these offer a nice complement to the super risky stock models that we discussed earlier. The first strategy that I'm going to walk you through is the Generalized Protective Momentum model. The key investing insight here is that by investing in a diversified set of asset classes that have both strong momentum and limited correlation with each other, you can get superior risk-adjusted performance versus a standard 60-40 portfolio. At a high level, the strategy invests in the assets with the best combination of momentum and that lack correlation with each other among a diverse group of 12 different asset classes. It invests in the 6 asset classes with the highest score using a system that combines momentum and correlation, and it will move aggressively to cash protection when the assets in the selection universe enter a downtrend. As for the source and the evidence behind the strategy, this is built actually off, it's a derivative strategy of another model called protective asset allocation. And protective asset allocation was tested from 1970 to 2015 and showed better risk-adjusted performance and raw performance actually versus the market and a 60-40 portfolio with significantly less risk, at least in the back test. The investment thesis here is this: by using momentum and focusing on limiting correlation among portfolio holdings, investors can actually boost their risk-adjusted returns and help protect from major declines when compared to static asset allocation approaches. So what this model does is it starts by selecting from a group of 12 different asset classes. So it looks at the S&P 500, Russell 2000, NASDAQ 100, European equities, Japanese equities, emerging market equities, long-term treasury bonds, high-yield bonds, corporate bonds, commodities, gold, and real estate. Of the 12, it holds the top 6 performing asset classes based on a combination of momentum and correlation. So what it does is it says what asset classes have performed the best over the past 12 months. And then what it also does is says, okay, of those asset classes, they want to bring in, the model wants to bring in those asset classes that are less correlated to others in the investable universe. The portfolio is actually rebalanced monthly, so it's a pretty active strategy. As the momentum shifts and changes, this portfolio will be making adjustments on a frequent basis. And the last unique part of this is the model has an automatic ability to flex in and out of its risk assets when needed in an effort to minimize major drawdowns. So what happens specifically is when 6 or more of the assets have negative momentum, the model can move to a 100% crash protection position. Because what that basically, what the authors sort of outlined in their paper was, once you have 6 of these asset classes all exhibiting negative momentum, it's usually there's something potentially really wrong in the market, and there's, you want to start reducing risk and putting on crash protection, because should things get worse, another bear market come or something else happen, a major decline, this portfolio is trying to react to that. It's really trying to limit that with that crash protection overlay. Okay, the last strategy we're going to look at is probably the simplest one. It's the permanent portfolio. And the investment thesis here is that investors can build a portfolio that offers long-term growth, income, and protection from inflationary and deflationary environments using a combination of stocks, bonds, and gold. The strategy invests in 25% of its assets in stocks, 25% long-term treasuries, 25% in short-term treasuries, 25% in gold. We do run a modified version of this that will invest only in the assets that are currently in an uptrend among the 4 in the universe. The source and the evidence behind the strategy: the concept was developed by Harry Brown and written about in his book, Fail-Safe Investing, Lifelong Financial Security in 30 Minutes. From 1976 to 2016, a hypothetical permanent portfolio backtest produced a return of around 8.6% annually with a standard deviation of only 7.2% a year. So that's a pretty good return with pretty low variability. The investment thesis here is the combination of uncorrelated and different asset classes helps limit drawdowns and volatility, thus helping the investor following this type of strategy generate steady returns over time. And particularly in a market like this where there's a lot of uncertainty, this type of strategy can be good for investors. By removing a lot of the volatility, they can stay with the strategy and they can get the most out of it over time by just kind of compounding it out. You're really not shooting for the stars here. What you're really trying to do with this type of approach is not lose a lot and just stay committed to it for the long run. We already kind of went through this, but the strategy starts by allocating across 4 different asset classes. So it wants stocks for the growth and prosperity periods. It wants gold for the inflation hedge, long-term bonds for falling rates or deflation, and then cash or short-term bonds are the safest asset and provide sort of the core safe asset that shouldn't have a lot of risk or variability at all. Each asset class is allocated to equally, so there's 25% in each. And then with something like this, you could rebalance the portfolio on an annual basis. So what that would do is you'd harvest your gaining positions and you'd redeploy maybe in the positions that hadn't done as well. And so that would kind of keep the portfolio in check and keep these allocations equal so that the portfolio doesn't become too weighted, towards one asset class or another and actually up the risk profile of the strategy. Okay, now we're going to take a look at how these ETF models and strategies are run on Validea. So let's take a look at that now. So to get to the ETF model portfolios on Validea, you just go to ETFs and you can go all ETF portfolios or risk managed portfolios. Since the portfolios we talked about in today's presentation are both risk managed, I'm just going to focus on these for today. Maybe in a future webinar, we'll look at some of the other ones. But here are the risk managed portfolios. You can kind of see the returns going back to 06. I mean, they're pretty decent. I mean, the 60-40 has been, it's been a tough portfolio to beat just because the U.S. market, specifically the S&P 500, that's been a very tough index to beat. And obviously rates have continued to fall. And so bonds have been, a pretty good investment, a very good investment actually. But these strategies sort of are alternatives to the 60-40, and they do have different types of characteristics and different types of systems, let's say, behind them. So just looking at the generalized protective momentum model, that's the first model we looked at. As you come into the portfolio page, it's the same format as the stock portfolios I showed you. What you're going to see here is an explanation on the strategy, what it's trying to do. You're going to see the long-term performance chart of the strategy. So it'll pop up in a moment. There it is. You see the full return history. So this is valuable, especially if you want to see, how a strategy like this really holds up when there's a lot of market stress. So you might look at 08, obviously 2020, in different periods of the market where there was a lot of stress. If you're looking for something that has the ability to protect in those periods, this might be an interesting one to consider. And then you come down here, you see the holdings of the portfolio, the last changes that were made, and you can also see at any given time, you can see the holdings of the portfolio at any given date in time going back historically. 2 other pieces of ETF research that I think are worth sharing. One is our ETF factor report. So our ETF factor report allows you to see how roughly 600 equity ETFs score across popular investment factors. So how an ETF scores based on size, value, momentum, low volatility, quality. You can see how the ETF stacks up based on its underlying holdings. So I just thought we'd look at XLK, which is one of the leading technology ETFs out there on the market. You have a table at the top that shows total assets, the expense ratio, active share versus Russell 2000, fee for active share, the highest scoring metric, which is price momentum, and some other sort of unique details that might not be necessarily easy to find on the web. Coming down, you can see how the particular ETF scores based on these factors. So this is obviously holding large cap stocks mostly. So it gets low on size, low on value, which is what you would expect because a lot of these names in the ETF are value names, but very high on quality. Makes sense. Low on negative quality, very high on momentum, and then low volatility, which, you know, even though it's high on momentum and the price performance has been strong, you haven't had a lot of deviation necessarily in terms of the variance of the returns. So the standard deviation or the beta. Coming down here, you get to see the sector exposures and the industry exposure. You can see the comparable ETFs that look similar to this one that may have somewhat similar holdings. You know, if you're looking at an ETF and you're sort of saying to yourself, that looks a little bit expensive, or maybe it doesn't have as much exposure as I'm looking for, the comparable ETF list might be a good way to identify other alternative ETFs that you might be interested in within roughly the same category of fund and style and strategy. Just a few parting thoughts before we wrap things up. First, I really hope I delivered on this part of the big idea that I read to at the beginning. I'll read it again. As you look to expand your investing knowledge and improve your chances of success in the long term in the markets, my hope is one or many of these models we looked at today can help you in your investment research process. Whether or not you use Validea, I think many of the strategies, and in particular the key investing insights I shared with you, can work for you if you have the ability to think long term, maintain discipline, develop a process, and have a set of rules you follow in your investment decision making. All of these models are a set of rules that are grounded in investing concepts and principles that should make sense to you and work over time. You can learn more about Validea at validea.com. All of our subscriptions come with a risk-free trial. If you have questions or would like to speak with me, you can email me at jcarbonneau@validea.com. You can also follow me on Twitter at @jjcarbonneau. And then lastly, check out our podcast, Excess Returns. You can watch it on YouTube and or listen to it on Apple Podcasts or any major podcast platform. Thanks so much for hanging in there with me, and we look forward to seeing you on Validea. Take care.